So that's direct materials, direct labor. Many of you will end up working for a service company. This is the one that counts. You know, if you work for an accounting firm, every partner is considered a responsibility center. You know, think about it, consulting. And then they report up to a group. Maybe there's a partner who reports up to the financial services group, which does all of the various financial services clients. And that gets rolled up, and each partner says, well, we think we're going to be able to sell this amount of work for these various clients we have. You have to figure out how many people you could hire, or how many people you need to hire, or do you need to shift your resources in some way. And so hiring of direct labor is an important part, both skilled labor and unskilled labor. So direct labor budget is prepared for every class of labor in the organization. It's derived in a manufacturing setting. It's derived from the production budget. You need to know how much you need to produce, so therefore you know how much labor you need to produce that. In a services organization, it's derived directly from the sales budget. And we'll talk more about standards, but you would use standard labor hours and standard wage rates to determine these budgets. So Kerry Industries knows they need a half an hour of semi-skilled labor and 2/10 of an hour of skilled labor to produce a product at $8 and $12 per hour, and then the math becomes pretty straightforward. You know how many units of production you have. You need a half an hour per unit. That's the total number of hours of semi-skilled labor at $8 an hour. That would be the total cost of your semi-skilled labor, and the same thing would be done for your skilled labor. Again, driven by the production and sales budgets. Factory overhead, not going to get into it in too much detail here, but you need to do the same kinds of things for factory overhead. That could be done at an activity-based level. You can do activity-based budgeting, ABB, which you would use in an activity-based costing environment, where you look at your expected number of setups, your expected amount of machine maintenance, and each of your activities, driven from an appropriate cost driver. In this more simple example, this is driven just simply by direct labor hours. And so this is more volume-based. So the various variable and fixed overhead categories are budgeted going forward. As you'd expect, fixed doesn't change or shouldn't change because it's fixed. And the variable is based upon the amount of expected direct labor hour usage, which in itself is driven by the amount of production, level of production, which itself is driven by the level of sales. You can now start to put together an income statement by period. Pro forma, meaning looking forward. You have your direct materials and your direct labor for April, your factory overhead, both variable and fixed. You have your cost of goods manufactured minus your beginning inventory, or plus your beginning inventory, excuse me, and then minus your ending inventory, and this will be your cost of goods sold. So this is just taking the numbers you've created in your budgets and starting to produce